Good afternoon, everyone. I welcome you all in this today webinar on FEMA Taxation and Incorporation Overview. Today we will discuss a brief intro about foreign company incorporation, especially in US, UAE and Singapore. Also, we will discuss FEMA import-export compliances and FEMA ODI compliances. Also, we will discuss UAE taxation and US taxation. We have with us a very senior cost accountant and company secretary, DC Arya ji. He is our session chairman. I welcome Arya ji. Also, I welcome CA Govind Rai Garg ji, our session speaker, and CA Ravi Singla ji, our session speaker. So I welcome all of you, and I now request Arya ji to please give his opening remark. Arya ji, over to you.
Thank you, Chawla साहब. ओम भूर्भुवः स्वः तत्सवितुर्वरेण्यं भर्गो देवस्य धीमहि धियो यो नः प्रचोदयात्. मैं सर्वप्रथम उस परमपिता परमेश्वर का धन्यवाद करता हूँ कि उसने मुझे आप सबसे मिलवाया. मैं राज चावला जी का धन्यवाद करता हूँ कि उन्होंने मुझे ये मौका दिया. मैं दोनों वक्ताओं का भी धन्यवाद करता हूँ कि उनसे आज हमें जो है ये विशेष जानकारी प्राप्त होगी. आज का टॉपिक फेमा पे है और ज़्यादा जो इसको ज्वाइन किया हुआ है दे आर चार्टर्ड अकाउंटेंट्स. चार्टर्ड अकाउंटेंट जो है एक आम आदमी की, आम बिजनेस की व्यक्ति की परिभाषा क्या है? एक आम आदमी की या आम बिजनेस के व्यक्ति की परिभाषा ये है कि चार्टर्ड अकाउंटेंट वो डॉक्टर है जिसके पास धन से संबंधित उनकी हर जरूरत का, हर समस्याओं का समाधान. और वो सारा समाधान कहाँ से आता है? वो सारा ज्ञान से आता है, नॉलेज से आता है. आज का युग इंफॉर्मेशन का युग है, नॉलेज का युग है. आज जो है हमारी जो यंग जनरेशन है वो बहुत जो है ज़्यादा नॉलेजेबल है, फॉरवर्ड है, मल्टीपल एजुकेशन में, मल्टीपल प्रोफेशनल नॉलेज में विश्वास करते हैं. एक चार्टर्ड अकाउंटेंट के लिए फेमा जो है बहुत ज़रूरी है, उसकी जानकारी होनी चाहिए. तो हमारे क्लाइंट को विदेश से व्यापार करना है, विदेश से इंपोर्ट करना है, विदेश में एक्सपोर्ट करना है, कोई इन्वेस्टमेंट करनी है, कोई उसे कंपनी इनकॉर्पोरेट करके वहाँ पे कारोबार करना है, उसे पता होना चाहिए कि उस देश के कानून क्या है, वहाँ पे जो बिजनेस स्ट्रक्चर है वो क्या है, उसमें से हमें किस में लाभकारी है. हमें LLC बनानी चाहिए या कंपनी बनानी चाहिए. हमें मान लो उस देश में फेडरल कानून है जिसमें रजिस्ट्रेशन होनी है या स्टेट कानून में होनी है. अगर स्टेट एक्ट में होनी है तो स्टेट एक्ट क्या है, फेडरल एक्ट में होनी है तो फेडरल एक्ट में क्या है, वहाँ की रिक्वायरमेंट्स क्या है. क्या हमें कोई लोकल एजेंट की आवश्यकता है या हमें कोई लोकल स्पॉन्सर की आवश्यकता है, हमें वहाँ पे कोई बिजनेस एड्रेस देना पड़ेगा या हमें बिजनेस की कोई प्रॉपर्टी ओन करनी पड़ेगी, क्या हमें वहाँ को लोकल डायरेक्टर अपॉइंट करना पड़ेगा, क्या हमें वहाँ पे सिंपल कोई जो है अपॉइंट एड्रेस लोकल एजेंट अपॉइंट करने से हमारा काम चल जाएगा. वहाँ इनकॉर्पोरेशन के डॉक्यूमेंट्स क्या क्या है, वो जो भी रेलेवेंट एक्ट है. हमें कल को एम्प्लॉयमेंट करनी है, उसके लिए क्या एम्प्लॉयमेंट की जो है लाइसेंस लेने की ज़रूरत है, वो आइडेंटिफिकेशन नंबर लेना है, या हमें वो सारे लाइसेंसेस कहाँ से मिलेंगे, हमें अपना बैंक अकाउंट खोलना है तो कैसे खोलना है, उसके लिए रिक्वायरमेंट क्या क्या है. कल को जाना है, वीज़ा की ज़रूरत है तो वो क्या है, टैक्स के क्या बेनिफिट्स हैं, क्या नहीं है, वो सारी चीजें जो है, और ये सारी कंट्री स्पेसिफिक होती है। तो आज हमें जो है इन सारी चीजों की जानकारी जो है घर साहब से और उनसे हमें प्राप्त होगी। और जो है इसी तरीके से जब हम इंपोर्ट एक्सपोर्ट करते हैं तो हमारे इंपोर्ट की क्या रिक्वायरमेंट है, आरबीआई की क्या गाइडलाइंस हैं, हमें अथराइज बैंकर कौन है, अथराइज बैंकर के पास क्या डिक्लेरेशन देनी है, हमें कोई एनुअल रिटर्न फाइल करनी है, इन सब की कोई पेनल्टीज हैं, कोई हम अगर कोई वायलेशन करते हैं कोई पेनल्टीज हैं, इनके एरियाज के प्रोफेशनल्स कौन कौन हैं। अच्छा, ये जरूरी नहीं है कि सारे काम हम ही करें, पर हमें जानकारी होनी चाहिए ताकि कोई आए। शेयरिंग तो प्रोफेशनल्स में कॉमन चीज है। मान लो मुझे बिजनेस मिला है, मैं आपके साथ शेयर कर सकता हूँ, आप एक्सपर्ट हैं उसके, मैं रेफर भी कर सकता हूँ। ऐसा जरूरी नहीं कि फीस शेयर की जाए, मैं रेफर भी कर सकता हूँ, आप मुझे रेफर कर सकते हैं। ये सारा एक म्यूचुअल जो है वर्ड है। तो कुल मिला के आई एम श्योर आज का टॉपिक बहुत ही जो है नॉलेज वर्धक है, और रजिस्ट्रेशन के रिस्पॉन्स से ही पता लगता है कि इसकी जो है कितना महत्व है आज के समय में। तो मैं रवि गर्ग जी, पहले आप बोलेंगे या
गोविंद जी आप पहले सेशन लेंगे?
तो मैं चावला जी को कहता हूँ, सौंपता हूँ।
थैंक यू
चावला
आर्या जी
हाँ
थैंक
फॉर
यू।
योर ओपनिंग रिमार्क्स।
I will start.
या प्लीज, यू
Sir
आर म्यूट।
and Divan sir, am I audible?
Yeah, you are.
या प्लीज कंटिन्यू।
Thank you so much, Chavla sir. Thank you so much, Divan sir, for having us here and having us here to guide you all on foreign company incorporations and deep dive into the taxation and compliances. So I am CA Govind Rai Garg, founder of Left Brain Hotshots Consulting, which is a global consulting firm having offices in US, UK, Dubai, and Singapore. Our bread and butter is foreign company incorporations, its compliances and taxation. So I'll give you a brief overview of what is included in this. I'm sharing my screen for you to read something which I might miss while speaking. Is the screen visible?
Yeah, it is coming. Yeah, now it is visible.
So foreign
Perfect.
company incorporations is a professional opportunity. And the main thing is that you can incorporate a foreign company without you or your client visiting that foreign country. Specifically, clients approach for majorly 4 countries, which is US, UK, Dubai, and Singapore. Apart from that, many people opt for South Africa, Sri Lanka, and some European countries also. But tier 2 comes in for the Asian countries because there is a ASEAN-India Free Trade Agreement which gives rationalized and relaxation in custom duties. Now, opening a foreign company in itself, a package, a bouquet of service which brings incidental professional opportunities for us. For example, opening a foreign company, bridging audit requirement for foreign companies, applicability of transfer pricing both in India and the host country. Next is international group structuring. It should be a wholly owned subsidiary of the Indian company. It should be 100% owned by individual. It should be a LLC, or it should be into a free zone or mainland. These kind of questions are involved in international group structuring along with a group effective tax review. And when we talk about foreign company incorporations, it is India outbound. So we are taking an Indian business outside India. We are not talking here India inbound. Then there are other opportunities such as payroll, processing of foreign company, bookkeeping, bank account opening is one of the major challenge that even a lot of consultants face while opening bank account for their client company. Some people open a company in a country outside India, but face heavy challenge in opening bank account. Next is group effective tax review. Then there is a Madrid portal on which you can register global trademarks for various countries in a single go. So suppose there is a company which is doing business in India and wants trademark protection in other part of the world. So there is a global trademark policy also, by which we can protect our trademark in and around the world. Then there is a RBI and FEMA advisory, which is really important because the penalties and the regulations are very strict with respect to FEMA and RBI. Primarily, if you open a company outside India, there are three compliances with India perspective. One is ODI requirements. So RBI wants a company RBI wants a person who is opening a company outside India to intimate before opening that they want to incorporate a company outside India. Now there is a chicken egg problem. When there is no company, how should we intimate RBI about opening a foreign company? So in many of the cases, what happens is that simultaneously we start the process of opening the company, and RBI levies a penalty of INR 7,500, which is called late submission fees. Then there is a FLAIR reporting, which is called Foreign Liabilities and Assets Information Return. The due date for this is 15th July. This is filed on the basis of financial statements of the previous financial year. The third and most important requirement from RBI is annual performance report. As the name says, it is an annual return and we have to submit it by 31st December. So now there is a challenge for clients, but a professional opportunity for us because of APR. Some years back, APR was not requiring audit report of the foreign country if the audit is not applicable in foreign country. Up to last year, people were filing foreign financial statements by getting them audited under a special purpose audit by an Indian chartered accountant. But with this year, we have been receiving a lot of queries that the foreign company financial statements should be audited by an auditor of the host country only. And this has created a huge demand supply gap between foreign auditors and the foreign companies who are headquartered by an Indian shareholder. So point number 3 is giving a lot of business to foreign auditors, and the Indian chartered accountant or Indian consultant, if can bridge the gap, can charge a good fees for bridging the audit and the auditee. There are certain red flags while opening a company outside India. So suppose Mr. A has a company in India. Mr. A is in India. He opens a company in Singapore, and then the Singapore company, another subsidiary in India. This will be called round tripping. So A, B, C. A and C cannot be in India. If this happens, this is called round tripping and it is not allowed by RBI. And this challenge is being faced by more than 20% of people who are opening company outside India, because many people do not have knowledge that round tripping is not allowed and go ahead with opening a subsidiary of a foreign company in India. Next is that an individual cannot open a step down subsidiary, which means A can have a company in Singapore, but that Singapore company cannot have another subsidiary anywhere. But a corporate can have, but it can also have up to 2 layers. So India Private Limited holding in Singapore, then Singapore can hold another subsidiary in any part of the country. Then when you have to make investment outside India, there is a limit of 400% of net worth in case of companies and up to the limit of LRS in case of individuals. So while we think of a project, while we think of a business outside India, we have to think whether do we have that net worth in our books so that we can make optimal investment outside India. In individual's income tax return, if the individual becomes an authorized signatory in the bank, there is a mandatory reporting in income tax return for that bank account or any asset or any liability that is being held outside India. So being an authorized signatory in a bank is considered an asset outside India. I've picked the major 4 countries for the taxation. That Ravi will take a deep dive into other taxation matters.
Govindji,
While
Govindji, can you please go back to the previous sheet? Last 3-4 points I am. Can you repeat? Yeah, five,
which one?
six, seven, eight. 5, 6, 7, 8.
Okay, so point number 5 means place of effective management rules. So when an individual opens a company outside India or an Indian corporate opens a company outside India, the management is sitting in India. So the entire business is being run by India and the foreign company will be classified as a shell company. In order to satisfy the place of effective management rules, which means POEM rules, we should bring management fee in India from the foreign subsidiary subject to transfer pricing. Both the transfer pricing, both countries' transfer pricing regulations should be managed by a benchmarking report while bringing management fee. Point number 6 is ODI compliance covers financial commitment if money not sent outside. So this is the thing that I was speaking, that there is a chicken egg problem. RBI says, let me know that you have opened a company outside India, even if you have not made any overseas direct investment yet. Because ODI takes a month or two after incorporating a company for remittance post authorized dealer bank approval. So there is a form which is called non-financial commitment intimation to RBI that we have opened a company and we will be sending funds outside India. Point number 7 is that you can send, point number 7 and 8 are related. It says that when you want to invest outside India, you cannot invest unlimited amount. There is a limit on funds being sent outside India. If you are an individual, you can send maximum up to the LRS limit, which is USD 2.5 lakhs. And in case of corporate, you can send 400% of your net worth. So recently we faced a challenge in a client. The client had a new company in India whose net worth was only 1 lakh rupees. It was only share capital was infused. And he opened a subsidiary in Botswana for 100 crore rupees project. And then he came to us, somebody got his company open and then he came to us, how should I send my funds outside India? Now you imagine if a holding company has a net worth of 1 lakh, how can it send 100 crore outside India?
So what you did then?
No, so what we are doing is what we have advised them is that let's merge the Indian company with another company of theirs. They had a pre-existing company in which the net worth was there to the tune of the investment required. So we are getting a merger done of both the Indian companies and then we will remit the funds.
Okay, and my
Ma'am,
question
is it
is,
possible?
I
Is it
think
possible
I
to
think group
please ping
group
the message? Yeah.
net worth is also taken by AD banks. It-
See,
Please
what
post
we
the
can do
queries
is
in the
you can
message
post
group.
your question in the chat
Yeah.
box and we can take it in the last of the session. So US has two types of income tax. One is called federal tax, which is fixed 21%, and another one is a state tax, which differs from 0 to 19%. Suppose in New York it is 8.8%. So a company incorporated in New York will have an income tax rate of around 29.8%. In UK, there is a slab rate. You basically in UK there is a slab rate. There are two types of income tax rates. One is 19%, another slab is 25%. Usually companies fall in 25% only because the slab is not very high. Singapore is a very beautiful economy with respect to taxation. One, their tax rate is 17% flat. Then there is a exemption available for first 3 years, which to small and medium businesses gives a tax rate of only 6 to 11%. People are mad about opening a company in Dubai because of low taxation there. Earlier it was 0%. Since June 2023, it is 9%. But to me, Singapore is a much better economy than UAE to open a company in terms of taxation also. Sometimes the tax rate in Singapore is way lesser than Dubai. Apart from income tax, there is a indirect tax applicability also. So all countries indirect tax are in line with GST provisions in India. It is similar. Export refunds are there, refunds are there, GST returns are there, sales return is there, purchase return is there. So in US, sales tax is 0 to 7.5%. In UK, it is 20%. UK VAT is very simplified. You file your return, you file your GST return on monthly or quarterly basis. And if there is a refund in the return, it will automatically be credited to your account. No need to file any refund application, no need to justify anything. You just file your return and they will remit back. If they have any question with your refunds, they will send a separate notice. But you get your money as soon as you file your return. In Singapore, there is a GST of 9%. In UAE, there is a VAT of 5%. In UAE, now there is a challenge of claiming VAT refund because they have implemented a $40 surcharge on some export of few products. And in order to take refund, you have to pay that. So there is a choice problem whether to pay $40 per ton or to claim VAT refund. These are the timelines for incorporating a company outside India. In US, it takes 5 to 10 days. We have written it on a conservative basis. Otherwise, it takes only 24 hours in US. In UK, it takes 5 to 15 days. Singapore, 2 to 7 days. UAE, 20 to 25 days. Now, if we talk about mandatory requirements, in US, you do not need any physical presence, neither for bank account, nor for opening a company. But there is a mandatory registered agent required in US, which we provide. In UK also, there is no mandatory requirement of a local person, but in order to open a bank account, banks require a local person to be there. So the company's house, which is called HMRC company's house there, it does not require a local mandatory director, but bank accounts want a local director there. The alternative to this is that the Indian business has banking with global banks such as HSBC, do a certain amount of business with the bank. I think it's $3 million or something total global business. And then they open your bank account in UK also without having a local person there. In Singapore, there is a mandatory requirement of a local Singapore director, which is called a nominee director. It is provided as part of a service. One company secretary and registered office address. In UAE, there is no requirement of local mandatory director, but in order to open bank account, the director or shareholder who wants to become the authorized signatory has to visit UAE for biometrics also. Opening a bank account in UAE is the hardest challenge that we face and the clients face. But now that we have gained hands, the way is also becoming easy. But if I categorize easy, medium, hard, you can see on the screen, US is very easy. It's a vanilla scoop. UK has some choco chips. Singapore has some choco chips, but UAE is completely tutti frutti and choco chips, everything mix. So there are some post-incorporation compliances. In US, the audit is not mandatory unless the Articles of Association demands an audit, or a lender or investor, or it is a public company. Otherwise, there is no audit applicable in US. In UK, there is a limit of on turnover for applicability of audit. Singapore also, depending on the employees, asset and turnover, audit is applicable. In UAE, it depends on the free zone and business activities. But nowadays, what we are seeing, and we are really happy about it, that because of APR, all the foreign clients whose owners are in India have to get their foreign companies audited by a foreign auditor to submit along with annual performance report to RBI. This is all from my side. Now Ravi will take a deeper dive on what broadly I have covered. Ravi has prepared a PPT which he will run, and it has a lot of ground level details. So Ravi, over to you. Any questions to me with respect to my content, you can post in the chat box and we will take it up in the last part of the session.
Thank you, Govind. Thank you, Raj Savla, sir. Thank you, Divan, sir, for having us, for giving us opportunity to speak on US UAE taxation FEMA perspective. So let me share the PPT screen. Is it visible now?
Yeah.
So let's start with FEMA, outbound investment as per FEMA compliances. So what is outbound investment? So outbound investment, we are speaking from Indian perspective. For example, if any Indian citizen, if an Indian business want to grow outside India, wants to invest in any other country in equity shares, in immovable property, or want to repatriate amount for the loan family, for the family, gift, etc. So in that perspective, outbound investments. So in this PPT, we are specifically focusing on incorporation of the company. So how a company can grow outside India. So basically, FEMA, who governs these acts? So FEMA 1999 Act. So basically, that is governed by the FEMA Act. Further, foreign exchange management regulations, RBI directions. So in 2022, major RBI direction was amended, and in 2022, some from various amendment was there, and everything was changed in 2022. So before 2022, for example, there was no clarity on step-down subsidiaries, but after 2022, step-down subsidy was not allowed in the case of individual before 2022. So there was no clarity on how much company can invest outside, how the net worth can be calculated, who can value the net worth, who can value the foreign subsidiaries. So after 2022, there are clarity on all these aspects. So also these are aligned with the Companies Act 2013, Income Tax Act. So FEMA guidelines along with RBI guidelines all covers outbound investment actually. So who are the regulatory authorities? So these FEMA guidelines are authorized by the RBI, AD banks, Ministry of Finance, and MCI. They are collectively making the guidelines so that they are aligned with other laws. For example, MCA, RBI, they are all aligned with the Income Tax Act, GST Act. So there will be not any contradictory statement by one act in respect to the others. So how one can invest outside in US, outside India? So there are the two routes. One is automatic route, another is approval route. So majority of the investment you can do with the automatic route. So in automatic route, there is no prior approval required. In the case of corporates, LLP, you can invest up to 400% of the net worth. In the case of individual, you can repatriate easily up to the amount of 2.5 lakh AD, 2.5 lakh USD. So faster in automatic route, it is little faster. There's less regulatory burden. So in case if you are investing more than 400% of the net worth, so in that case, RBI approval is required. So in case investment exceeding prescribed limit, so we have to take RBI approval. In case you are repatriating more than 2.5 lakh USD, then in that case, RBI approval is required. So if we are dealing with countries that are sharing land borders, for example, with Nepal, Bhutan, Sri Lanka. So Sri Lanka is also covered in this. So in that case also, land approval is required, and specific structures like round tripping. So in the case of corporates, if you're holding the structure and there are the more than two layers, so in that case also it is round tripping and RBI approval is required in that cases. In the case of individual, if you have opened the step down subsidiaries, so that is also will go in the compounding and RBI approval required. So maximum cases will fall in automatic route, and other, for example, if we have exceeded the investment and exceeded the prescribed limit, then we have to do the approval limit. For example, you are investing in a sector that is regulated by the RBI. For example, if you want to invest in finance sector, if you want to invest in construction company that basically do sale and purchase of real estate, so in that case also that is gone under approval route. So another is who is Indian party on which it is FEMA is basically governed. So Indian party is company incorporated in India. So any company that is incorporated in India under MCA, under Companies Act 2013 or earlier Act 1956, that is covered under Indian party. Another is body corporate. So any body corporate that is created by the Act of Parliament is also covered in it. LLP, limited liability partnership, is registered in India, that is also covered in Indian party. So partnership firm. So partnership firm under Indian law, that they can also invest, but only registered partnership can invest. So investment shall be bona fide activities abroad, prior RBI approval is required for certain structures. Partners will be jointly and severally liable for the obligation. So in the case of resident individuals, they are permitted under LRS. So there's not any limit for 400% of the net worth in the case of resident individual. They are permitted to under LRS, liberalized remittance scheme. So that is investment limit is up to 2.5 lakh USD per financial year. For example, if we want to repatriate for family members and also want to repatriate to purchase the shares and immovable properties. So for complete year, the limit is 2.5 lakh USD per financial year. So in the case, there are the 5 members in the family. So each members can repatriate 2.5 lakh USD per financial year. Even if the child is minor, even if child is 5 year old, that child is also can repatriate 2.5 lakh USD. So effectively, if there are 5 members in the family, the 5 members collectively can repatriate 12.5 lakh USD per financial year. So the limit is not small, but if someone want to make a big project, someone want to invest in, for example, 100 CR in millions. So in that case, that can be routed through only corporate structure. So in that case, 400% limit will be applicable, and make sure that the net worth is as such that it is covered in the 400% of the investment net worth. So another entities that can invest is trust and societies, but I have rarely seen that the trust and societies investing outside India. So, but in activities written, and they can invest outside India with RBI approval. So eligibility depend upon the entity type. How much you can repatriate, that totally depend upon the entity type, that is either individual or company or LLP or partnership firm, and subject to approvals. For example, in case that subject specific approval is required. For example, you cannot invest outside India in the defense project. So in the case of defense project, you shall have RBI approval outside India. So real estate sector that I am saying for for the development of township, it is allowed, but for the sale and purchase of real estate activities, it is not allowed. So another is type of investment abroad. How you can invest abroad? So it can be by purchasing of the equity share capital. You can purchase the equity share capital. You can make the wholly owned subsidiary outside India. You can purchase the share and run the business as a JV. For example, many Indian entities are going abroad and make the JV with the local company of that country. So you can also do that. You can purchase CCPS, compulsory convertible preference share. You can purchase compulsory convertible debentures, but make sure in the case of individual, loan is not allowed. In the case of corporate, you can repatriate the loan only if you have if that company is a subsidiary of Indian company. Another how you can purchase, you can acquire through existing shareholders. You can purchase the shares through existing shareholder. For example, existing shareholder, you want to sell the company, you can purchase that. But in that case, also separate valuation report is required, and also RBI. You have to intimate to the RBI that we have purchased the share outside India, and Form FC is required to file. And another is by gift. You can acquire the shares of a company or any other thing. For example, you can acquire the immovable property also through the gift, but there's a separate regulation for the gift also, that who can transfer as a gift. For example, a resident of an Indian resident cannot give to a non-resident. So there's a specific regulations of gift also. You can get the property to inheritance also through ESOP and sweat equity. For example, many Indian individuals who are doing job in Indian companies like for Google, Microsoft, or many other companies, they are getting ESOP of US companies, sweat equity of US companies. Either they are paying very less, or they're not paying at all. So they that are allowed under Indian Act as per FEMA, that they can hold the shares that they have acquired through ESOP or sweat equity. But the condition is you have to report that sweat equity or ESOP in your income tax return. In schedule 4 and in schedule of FA, you have to report that you are holding this much of amount of the share, and the cost of investment is this. Otherwise, they are treated as illegal. Another thing is that we have seen many cases also. For example, you have you have get the shares to ESOP, and you have sell the shares in US, for example, and you're not reporting in India. That's also the against the law. You have to report that the sale in India, that is taxable also in India. If any taxes was deducted in US or any other country, you can get the phone tax credit in India. So make sure you have to report that ESOP or sweat equity in India as well. So how basically what is the promotory structure abroad? You can open a joint ventures abroad. You can open wholly owned subsidiaries. You can open the step down subsidiaries, but make sure step down subsidiary is not allowed in case individual is opening the company abroad. But in case a corporate has opened the company in US or any other country, so step down subsidy is allowed up to the 2 layers. So for example, if I have opened the company in US and that US company cannot open further step down subsidiaries, it will be the violation of the law. And second case, if an Indian company, a private limited company, opens a subsidiary at Dubai, for example, so Dubai company can further open 2 step down subsidiaries. For example, company A at India and company B at India only also. So in that case, make sure that are wholly owned subsidiaries. If they're not wholly owned subsidiaries, then Dubai company will be considered as first step down subsidiary and company A will be considered as second step down subsidiaries. So if they are wholly owned subsidiaries, then you can company A and company B will be considered as one company. They are further, they are limiting on the step down subsidiaries. You can open the multiple layers company in if you are holding the company, US company through Indian company. For example, if Indian company opens a company at UAE, Dubai, for example, and Dubai company can open 5 to 6 companies. That's not any limitation. But step down subsidiaries, they have a limitation. So actually, in any case, there must be bona fide activities. Investment must comply with the sectoral restriction in the host country. Real estate and banking business not allowed. So there's a specifically provision for real estate and banking business. And in real estate, it is purchase and sale of real estate. So there is a loophole in the act. You can purchase the property, you can purchase the plot, you can develop that plot, you can make the residential compartment or commercial compartment or commercial, then you can sell it. That is allowed because they're not specifically mentioned in the act actually. So what are the property sectors? That is real estate, trading in real estate, or buying vacant land and then sell. It is not allowed. Banking business, it is not allowed unless you have taken specifically approval by RBI. Financial product, for example, speculative, leverage product not permitted. You cannot repatriate the amount outside India for betting, gambling. That's also not allowed. Another is geographical restriction. So that is also the important part. For example, you can't invest in a company outside India in any country that is identified by FATF as a non-cooperative jurisdiction. FATF means Financial Action Task Force. So they are identified a jurisdiction that is high risk because of they're not sharing either they're not sharing the data with Indian authorities on the double tax avoidance agreement, or either they have not any DTW with India. So they are identified that cases. So they are listed down in FTF websites that they are the non-cooperative jurisdiction, or they are also the countries that have low tax or no tax. So that are also the that is also identified as non-cooperative jurisdiction by FATF. So in that country, you cannot invest. And in case you want to invest, that is required pre-approval. If you have invested already, so there's a huge penalties for that, and it is very difficult to get the approval for that countries also. So, for example, Pakistan. So also land boarding share. If you are investing in any land border sharing countries like Nepal, Bhutan, also. So in also that case, you will require prior approval from the RBI. Other restrictions, round tripping structures not allowed. Investment not backed by the bona fide business activity. That's also not allowed. So another is practical compliance risk. Investment in tax havens, for example, earlier Mauritius was used to be tax havens. British Island, that was also the tax haven. But in these countries, if you have invested any share or hold any shares, that will definitely invite RBI scrutiny. So further, if you have remit funds outside India and have done incorrect classification in purpose code basically, so that's also led to FEMA violation. For example, if you're repatriating the money outside India for the purpose of purchasing the involved property, but in FEMA, in purpose code, while giving to the AD banker, you have mentioned that I am giving gift to my relative. So that is incorrect classification and will lead to FEMA violation, and they use penalties for this. Non-reporting or step-down subsidies also trigger penalties. So permissibility is subject to sectorial, jurisdictional, and activity-based jurisdiction. Another is automatic route that we have already covered. Financial automatic route limit, that is 400% of the net worth. So what is the net worth? So net worth is defined by the AD banker. So as per, they are considering last audited balance sheet. For example, if I have invested on 1st of April 2025, so they will require 31st March 2024 audited balance sheet for computing the net worth of that company. So in case, for example, if you are violating the law, for example, if you have invested outside India, for let us suppose if you invested outside India, you have done financial commitment outside India for 10 lakh rupees, and your net worth is only 1 lakh rupees as on 31st March 2024. So in that case, you are not able to do ODI compliances as on 31st of 2020 on the basis of 31st March 2024. So on 31st March 2025, you have to increase your share capital and make your net worth more than 3 lakh rupees so that it will cover the 400% net worth. So on the basis of 31st March 2025 audited balance sheet, you can do the ODI. Like that, it will works. So what is the financial commitment component includes? So I have done, everyone saying that we are only 400% of the net worth is allowed to invest outside India. So what is that? That is a financial commitment. So financial commitment has specifically defined by the FEMA laws. What financial commitment covers? So that is equity contribution. So what are the commitments I have made for equity, for purchasing the equity of any foreign company, that is covered under equity contribution. If I have given any guarantee, for example, they have given any loan to third person, and that person and that I have given the guarantee to on the behalf of that company to third person, that is also covered in this. If I have given loan to foreign entity, I in the basis of I means private company. If private company give loans to the foreign JV or wholly owned subsidiaries, that is covered under financial commitment. If you have purchased any compulsory convertible instrument, that is also covered in the financial commitment. So financial commitment will include equity contribution, compulsory convertible instruments, loans to wholly owned subsidiaries, any granted issued. One thing is that, for example, if you form the company in UAE, for example, so in memorandum of the UAE company, you have mentioned that share capital of the company is 2 lakh AD, and you are subscribed to you are subscribing the share by giving 2 lakh AD. So in that case, in UAE, there's not any requirement to repatriate the amount to contribute to the UAE company. But in India, that 2 lakh AED will be considered as non-fund based commitment, and you have to do compliance of this 400% of net worth in that case. Even if you have not repatriated the amount from India to UAE, but you have done financial commitment in memorandum of that company that I will invest so much an amount for purchase the equity share of your company, that is covered under financial commitment. So you have to comply with the 400% of net worth. If the amount is exceeding of 400% net worth that you have you have not complied the laws, and you have to take compounding for the RBI. So in the case of resident individual, the limit is 2.5 lakh AD, 2.5 lakh USD per financial year. So 2.5 lakh is include all the remittance that you have done throughout the financial year, even for education, travel, gifts, for any purpose we have remit outside India. Even if you have purchased overseas tour package, or you have remit amount to anyone, that all will include in 2.5 lakh USD per financial year. So another thing is that special case, for example, if you are investing in financial sector, abroad, then you have to take RBI approvals. Any investment abroad beyond limit also required RBI approvals. So investments in a link with the net worth and LRS cap for the individuals. So what are the key compliances that need to be do? So you have to obtain board and shareholder approvals. You have to verify eligibility, limit and sectorial restrictions. You have to done form ADI. So what the government was saying earlier, that the problem we are facing as a consultant, and every person, basically businessman and consultant, or basically all are facing this situation. So what they happen in Act, it is written that you have to done ODI filing at the time of acquisition of the foreign entity. At the time means if certificate of incorporation is of today's date, for example, 20th of September, then UN will be generated on or before the 20th September. That is kind of non-fund based commitment that I will open a company in UAE by this name, and this will be the share capital, and this much of the amount I will repatriate in UAE. But the thing is that once you will try to do form ODI part 1, that is non-fund based commitment, in that case, they will ask the things like memorandum, signed articles, certificate of incorporation, sometimes they also demand certificate of incorporation. These are never possible before incorporation. So if you have done ODI after 20th September, even on 21st September, the late submission fees of 7,500 will be levied. So this is a major issue that we are facing. So in that case, you will assume that 7,500 late submission fees is a kind of cost for done the ODI. So another thing is that after opening the company, you have to file the form FC with the authorized banker. Authorized banker might be your HDFC, Kotak, or ICICI Bank. From wherever the company has a bank account, current bank account, you can approach that bank and ask for the trade finance. Then they will help you to get the documents, and then need to be do form ODI. And similarly, in the case of an individual, wherever you have a saving bank account, for example, with HDFC, ICICI, SBI, or any other bank, you can approach that bank for the form FC. So that need to be routed through authorized banking channel. So after once the UN generated, any transactions that need to be done either either to repatriating from India to that company, or to repatriate back from that country to India by the form of dividend, salary, or by any other form, that need to be routed through that banker. Through that banker from whom you have generated the UIN, unique identification number. So after the company is incorporated, there are the major two compliances that need to be done. If the company is incorporated by Indian wholly owned subsidiary, if company is incorporated by Indian company. So if the company is incorporated by Indian company, so in that case, there are the two requirements. Basically, form ODI need to be done at the starting, first requirement. Second, FLA. Form file FLA need to be filed by corporates, either it is a LLP or it can be a private limited company, public company, whatever. So that need to be filed by 15th of July every year. So if you open the company by 31st March 2025, you have to file FLA by 15th of July. So that is basically need to be filed based on the, for example, on 15th of July, I don't think so that majority of the company will not close their books of account. So by 15th of July, you can file the FLA based on the provisional basis. Then you can amend the FLA and file the final after the books of account is closed. So second requirement is, third is basically from APR, annual performance report. So if you have incorporated the company on 31st March 2025, so what APRs, what FEMA laws says that you will have to file annual performance report by 31st December every year. So if I have incorporated the company 31st March 2025 in UAE, for example, and I have selected the calendar year of Jan to December in UAE, so my first books of account will be closed on 31st December 2025. So APR need to be filed by 31st December 2026 and not on 31st December 2025. So it's basically 31st December, 31st December after the year closed, after the financial year closed in foreign entity. So that need to be filed 31st December. If I have incorporated the company on for example, 31st December 2024, and my year, basically calendar year in UAE was 1st Jan 2024 to 31st December 2024. So in UAE, I have to prepare the books of account for 2024, even for one day. So that financial need to be filed on 31st December 2025. So in this, everything like disclosing, restructuring, the divestment, write-off, everything need to be disclosed in this. So another is divestment exit. If you have made any restructuring, if you have purchased any further share, if you are doing a divestment, so that we also need to be intimate to the RBI through form ODI only. So ODI ones need to be filed at the time of incorporation, and after that ODI need to be filed after every amendment that we will done, after every restructuring that we will be done in foreign entity. Either you, if you have opened any step down subsidiaries, either if you have purchased any additional share, if you have sold the shares, also that need to be filed. So after every structuring, you have to file form APR. So further in APR, it is mandatory to attach the audited financials of the foreign entity. So as Govind was also saying that last year, if, for example, if the company is in US, the US financial can be audited by the Indian chartered accountant. So it is specifically mentioned in FEMA Act that Indian chartered accountant can audit, can do special purpose audit for FEMA purpose. But from this year, AD bankers, what they are doing, they are asking for their local country auditors to get the accounts audited. So they will require the local country audited financial statement. So they have changed the things in US. For example, there is not any requirement for to get the accounts audited, but for the APR India purpose, it need to be get account or they need to get accounts audited from their local auditors. So another is, in case you get an divestment, you have to file with the banker Form FC. Along with the Form FC, you have to attach the valuation certificate basis on which you have sold the share. If you have purchased additional share, you have to attach the agreements with the agreement with the buyer, agreement with the seller, and also you have to attach the valuation certificate basis on which you have purchased the share or you have sold the share. And for example, if you have sold the share, you have to entire proceeding need to be repatriated into India within 3 months actually. So if you have delayed from 3 months, that it will then you have to prove the reasons that why you have not repatriated back in India. So this is also the another requirements. So there are the major things in various positions. We require valuation and pricing norms. So at the time of fresh acquisition, so there may be condition. For example, if you have incorporated the company only, then at that time you are the subscriber to the memorandum. At that time, valuation report is not required. So further, if you are doing transfer of the service shares, in that case, valuation is required. Divestment, if you are doing divestment, exit, if the structuring is done, for example, capital reduction, merger, buyback, right of the investment, so gift, inheritance cases, in all these cases, valuation is required. So further, who can do the valuations for ODI more than 5 million USD? So that need to be mandatory valued by the category 1 merchant banker. For investment, category 1 merchant banker or by the investment banker that can be registered overseas. A category 1 merchant banker that is registered in India can do the valuation. For smaller deals that is less than 5 million USD, a chartered accountant, CPA, they can do the valuation. They can do the valuation by any method. For example, a chartered accountant can do the valuation through net asset value method, balancing method approach. They can do on this message. You can get the valuation report from the RV, by DCA method, NAV method. You can do valuation on that basis. That's not an issue. So the major regulatory principles are price cannot be lower than the fair value for the sale. So if on valuation report it is mentioned that you are selling the share for 1 lakh USD, you cannot even take 99,000 USD as a sale value. So it will, if you have taken 99,000 USD for 1,000 USD, you have to invest a lot of time and energy. So proving that why we have not taken 1,000 lakh USD. Price cannot be higher than the fair value by the way of purchase. If you are purchasing the shares, the price cannot be higher by the registered value report. So in that case also, they will not accept that excess repatriation from India to that foreign entity. Must ensure that arm length prices in all related foreign tax transactions. There should be consistency between FEMA Act, Income Tax Act, and host country rules. So sometimes it occurs, for example, if you have done valuation and you have complied with the Indian laws, FEMA laws, but you are basically violating the foreign tax laws. That also will create the major issues in foreign country. For example, there will be huge penalties in that. So we have to make sure that whatever the transactions we are doing with foreign countries, we not only have to make sure that it is as per Indian laws, it shall be as per US tax laws, UAE tax laws in whichever country you want to invest. So this is basically about the value or ODI FEMA compliances for ODI perspective only. So next is FEMA. What are the FEMA compliances that need to be do for the import and export compliances? We have seen many cases. On that basis, we have prepared the things in this PPT. So you might have many clients that are doing import and export. So in that cases, what are the FEMA guidelines that need to be followed? FEMA not only comes when for ODI, it also comes when you're doing import and export. You are dealing whenever you're dealing with a foreign currency, FEMA will comes in. So what is the objective of this? Equip partners with practical knowledge documentation. What are the FEMA guidelines? What are the requirements? What are the regulatory requirements to ensure smooth international trade? So we will have to understand what are the mandatory documents that need to be do for all the essential export and import, such as commercial invoice, packing list, shipping bills, bill of entry, certificate of origin, bank statement. What are the purpose of each such documents? How it facilitate custom clearance, approvals, international trade transactions like that. What are the comprehend FEMA guidelines? What FEMA will say in the case of import? What are the documents required in that case? What are the documents requirement in the case of exports? So we have to check comprehend FEMA guidelines. How it can ensure smooth and compliant trade operations. For example, if you're not compliant with the local laws of the, for example, US, so the cargo, they will not clear the cargo, and the cargo will not clear the custom clearance, then it will be a major financial loss to you, because if you not get cleared, you will not get the payment. And if it is kind of perishable goods, so that totally cargo will get destroyed. So you can't, if you also ship back to India, that also will totally kind of destroy the quality of the goods like that. So what are the basically why import export compliance matter? We have to do the import export compliance to ensure legal trade operations. So we have to avoid violations of FEMA, Custom Act, GST, foreign trade policies to ensure all international transactions in smoother way. We have to comply with the export and import compliances. So to prevent any financial penalties and delays, if we have not done any compliances, if any single compliance got missed, so it will lead to huge financial penalties and delays in custom clearance, and also major hurdles in future trading also. Also, it will lead to business reputation, damage of business reputation. For example, if any listed entities, their cargo got stuck in somewhere due to some compliance issue, so it will impact the market in a negative way. The share price will get down, so it will prevent business reputation. To ensure smooth custom clearance, if you have documented the goods in a proper way, if you have documented everything in proper way, so it will ensure proper and faster clearance of the exports, ensure accurate financial reporting. So there's a various liability on chartered accountants also. So in case we have done any, if any client have done import and export and we are not showing it properly, if something is, for example, if I am exporting the services and in I have raised the invoice of 1 lakh USD, and in FIRC it is showing as 1.2 lakh USD. So there's a gap in 20,000 USD. I have received 20,000 USD, but I'm not recording books of account. So that need to check when the books, then that amount hit in my books of account, how they have done the entries in that. So we have to ensure that it should be matched with the books of account. And also, for example, in GST, it is written that you have to prepare the invoice in foreign currency unless and until it is exempted by law. So, for example, if I raise the invoice, so we have seen many cases that they have raised the invoice in local currency, and foreign company, but they have done, they are sending the money in INR. So in our bank account, payment is hitting at INR only. So in that case, you can't avail the exemption of zero tax. It is not considered zero rated. It is not considered zero rated, and it is not considered as export. In that case, you have to raise the invoice after applying GST. So this is the major discompliances you will see in day-to-day life. As specifically GST law says that it should be in foreign currency, and amount also it will be credited in your bank account in foreign currency. So once the foreign currency is credited, you will must receive FIRC, foreign inward remittance certificate. If you have not any FIRC, then GST department has right to rise to levy the GST and interest and penalties on that amount. So make sure you will raise the invoice in foreign currency, and also foreign currencies will be hit in your account. That's the major thing. So operational risk, you will check legal, financial, operational risk, minimize exposure to penalties, quantification, delay shipment. Another thing just want to highlight, while I was talking to export of goods, export of services, sometimes we have seen that, for example, you have raised the invoice of 1st of April 2024 by considering zero rated supply, and you're not levied the GST on that. So in that case also, if that amount is not coming back in India within the prescribed time limit, for example, 31st of March 2025, the amount is still due. So in that case also, GST department can charge, can raise the concern, and on that amount, GST will be levied, and also interest penalty can be demanded by the authorities. So please show that whatever the amount is receivable from the foreign country, that should be repatriated into India within the specified time limit. Otherwise, GST department will not consider as a zero rated, and you have to levy the GST on that amount. So another thing is, 1 second. Yeah. So I think just 1 second, I again sharing the screen. So we are on, yeah, on this slide. So now is, who is governing international trade regulations? So the international trade regulations is governed by the custom regulations, Custom Act, Custom Act, Foreign Trade Policy Act. So Custom Act govern the import and export of goods across the borders. Please ensure correct classification, valuation, and payment of duties enforced by the CBIC. Foreign Trade Policy, DGFT, Foreign Exchange Management Act. FEMA regulate cross-border financial transaction in India. So basically, import and export will be considered as current account, and FDI investment, that is considered capital account. So please ensure foreign exchange is used for permitted purpose only, and timely repatriation of the fund. GST and IGST compliance, export as zero rated supply under GST. So the thing that we are already discussing, that in case if the amount is not repatriated back into within stipulated timeline, that will not consider as export. And in that case, you have to raise the invoice with GST. You have to amend the bill. There will be major issue in that. So we have seen that cases in our past. So imports are also subject to IGST and custom duty compliance, ensure proper ITC and refund. So global trade practice, global trade, there are also global trade standards also, like ISO standard, INSO terms. So they are the international trade regulations that are majorly governing import and export. So next thing is, what are the export documentations that need to be maintained? So that is commercial invoice. So there are two type of invoice, that is commercial invoice, tax invoice. For example, if you are raising the commercial invoice basically in foreign currency, tax invoice, for example, if you are supplying the goods, exporting the goods after applying IGST, so in that case there are two invoices will be there. Also commercial invoice will be in foreign currency. Another is invoice, tax invoice will be in INR, that used to for recording transactions in our books of account. So that is a core document, the commercial invoice for export transactions. It must contain details like seller and buyer information, description, quantity, value of the goods, payment terms like LC, advance, open account, what are the payment terms, what are the terms, whether it is FOB, CIF, etc. So this is used by the customs for the valuation and the bank for the payment processing. So another is packing list, that is item-wise packing details should be there. That will be done by the shipping agents only. including dimensions, weight, package, marketing, help customers freight forwarders inspecting and handling. So another is shipping bill of export. So that requires for the custom clearance of export goods, act as a legal declaration of the exported goods, contain details of the goods, value, duty exemptions, any port of shipments. So certificate of origin, this is the major things that need to be do. For example, if with any country, India have trade agreements. So there is, if there are any duty exemptions in foreign country for the exporting the goods from the India, then you must have certificate of origin of India in that case. If there will be no certificate of origin, you will not get any duty exemptions in that case. So recently, you might heard for USA tariff. So on textile industry, diamond industry, you might heard that there will be 50% tariff on that cases. So we have received many queries for that and how it can be avoided, how whether is there any chance to shifting the operation from India to any other country, then whether it can be avoided or not. So the major thing was that you must you must able to obtain certificate of origin of local of that country. For example, many has shifted the operation from India to UAE. They have incorporated the company at UAE, but in UAE also there was a limit, there was a restriction for certificate of origin. There must be addition of at least 40% in terms of value. In that case only you will get certificate of origin. If you have shifted the operation from India to there, and if certificate of origin is not able, you will not able to get certificate of origin. There is not any such benefit then. Someone was saying that some trader was saying that if we open the company at UAE, if we do only high sea sale from India to US, then whether we can avail the benefit of US lower tax regime. So it is not possible actually. In that case, certificate of origin will be of India only, and you will not get any tax duty exemptions or lower duty benefits from UAE. So in that case, it will be considered as exporting from India only. So you make sure whoever opening the company outside India and any other country, there will be certificate of origin. So on the basis of certificate of origin only, you can avail the lower deduction, your lower tax benefit. So export declaration forms. So sometimes the government asks export declaration form for the statistical purpose. Letter of credit is a kind of bank guarantee, ensure exporter receive the payment once terms are met. Document is required that the LLC must strictly match terms to avoid discrepancies. Insurance certificate, quality inspection certificate. These are the basic document requirements for export compliances. Another is export contract. So you might see that might seen in many clients that they are doing high sea sale from India. For example, I am importing from, let us suppose, Europe, and before importing, before the custom clearance, if I have sold the goods to some other person in India, so whether it is covered under, whether it will be covered under accrual from, no, we will now check from, for example, US perspective. For example, if US person in exporting the goods from Europe to Indian entity, so what they have done, US, they have good was shipped from Europe, and before reaching the India, US company has sold to some other company in India. So whether the sale occurred will be considered as accrued from India or not. They were the major things that we have received many queries from the foreign companies on this regard. So there's the concept of TWI. For example, you must heard TWI. If the sale occurred within TWI of India, then it will be considered as sale from India, and that income might be get taxable from India only. So foreign companies that are doing high sea sale only, and if they sold within the TWI of India before the custom clearance, that might get taxable in India because they have that income will be considered accrual from India. Might be, we have not seen any case laws regarding this, but in future they might be, because this is a major issue. Then there's a backlog. As of now, department has not issued this, but not noticed this, but this can be in future. So in that case, you must have performa invoice or export contract, kind of contract between US company and Indian company. So US company makes sure that they have sold the goods after dispatching from Europe before entering the TW of India. So in that case, the export contract must be dated in such a way that once the goods are entered into delivery of India, before that they have executed the contract. So like that, contract, performance invoice, and export contract will play a major role in these type of transactions. So another thing is accuracy is crucial. Incorrect details can delay shipment or block payment. So digital filing options by iSCADE is active for faster processing. So another is import documentation. So like export documentation, we have to do the import documentation as well. So for import documentation, bill of entry need to be uh, bill of entry need to be do. So this is the basic requirement. So everyone shall have a bill of entry, commercial invoice, packing list, insurance certificate, import license. So in India, some goods are restricted and require DGFT or government approval. So make sure you will check the classification, accession classification, and check with the IEC, basically departments, whether these are permitted or not. You can check with the government website also with specific accession, whether whether the document requirement for that, any other clearance required or not. You can check easily on the government websites. For example, pharmaceuticals company, defense item, these are the these are the restricted entities. You can't import this without any import license or any permits. Another is payment document. You must have payment documents, ensure proper remittance and compliance with RBI guidelines. So you must have certificate of origin for any duty concession under FTA. You must have quality certificate. For example, some if you're importing medicines, there shall be quality certificate for that. There shall be reports of the prescribed authorities that are defined by the Indian medical. So like that, you must ensure like this. So what are the FEMA guidelines? So FEMA regulate cross-border financial transaction in India. So they will also ensure the transactions for import and export. So what are the classification transactions? That is current account, that is goods and services covered in current account, travel, tuition fees, foreign remittance will be covered in it. Capital account transactions that we have already discussed, like investments, loans, guarantees, acquisition of asset abroad, that is covered in capital account transaction. So yeah, so applicable to export import, exporter must realize the export proceed. So if you're doing export, so that must be realized within 180 days from the date of export. So make sure you receive the amount within 180 days, but the 180 days limit can be extended by the mutual agreement between the seller and buyer up to the 12 months. So you shall have that agreement, even if you have write on invoices that payment terms, if you write on invoice that what are the payment terms, whatever the written on the invoice, that will be automatically be considered as agreement. So you may write on that invoice as well. So importers must make payment through authorized banking channel only. So if you are importer, you have done an import, you can't remit other than authorized bank route. For example, if you have receivable from company A at US, if you have payable from company B, if you have payable to company B at UAE, you can't say to company A to remit to company B and Dubai. This is not allowed as per FEMA. You must quote it through AD bank only. You must receive from US to India first, then you from India, you can remit to UAE. You can't just say to company A to pay to company B. So also similarly, whatever the receivable you have, you must receive in your AD bank account with a specified timeline, that is 180 days. So you can't remit from you can't receive the amount outside India in the name of some other person, in the bank account of some other person. This is totally not allowed. So what are the reporting requirements? You must import export transactions through ADVMS portal or IDVMS portal. Bank may verify compliances before payment. So whether advance payment for imports are allowed or not as per FEMA. So importer can make advance payment to overseas suppliers. It is allowed as per FEMA. RBI allows advance payment up to 180 days before shipment. So if you have done advance payment to any vendor, you must receive shipment within 180 days from that advance. So it requires submission of shipping document once the goods are dispatched from that country from where you are importing. The document must be submitted to AD bankers to ensure that the advance is adjusted against that shipment. Another is export must receive payment for export within 180 days from the date of shipment. delays beyond this period require reporting to RBI with valid reason. So that thing that I was saying that 6 months can be extended to 12 months, but that need to be reported to AD banker. If you have specifically made an agreement or reported on invoice, that will be suffice the purpose. So another is capital account transactions include for investment, loan guarantee, acquisition policies, asset. So that also covered earlier. Property and restricted transactions, that is also covered. What are the reporting requirement? Export import must be reported by ATPMS or IDBPS. Authorized bankers ensure compliance with FEMA before processing remittance. Timely reporting reduce risk of penalties or transaction delays. So what are the penalties for non-compliance? Monetary filed by the RBI, freezing of accounts, seizure of foreign exchange, potential legal action for the repeated violations. So what are the FEMA compliance tips? What are the best practice that need to be do? So maintain accurate documentation. You must maintain all invoices, shipping bill, contracts, bank documents in organized way. Ensure dates, amount, and bank information are correct. Digital records reduce errors and facilitate reporting. We make sure that amount received within a specified time limit. Otherwise, they will be issued not only from FEMA perspective, also from GST perspective, income tax perspective. Also, advance payment must be matched with the shipment within allowed timeline. So that document when the goods are dispatched from the foreign country that needs to be submitted to AD banker to ensure matching with that advance payment. So you have to submit export import transaction detail by ADMPS, IDMPS bank. They require this report to process payment and for remittance. Timely reporting avoids penalty or compliance flags. So you must receive payments or pay any payments to RBI authorized banks only. You can't just settle the amount by payables to receivable. Even if, for example, if there's a company A, you have given loan to company A, and also what you have done, you have given loan to company A that is receivable. And if you have import some goods from company A, so you have payables to company A for current account transaction. You have receivable from company A for capital account transaction. You also not allowed to settle that amount also. That also need to be done through authorized bank. That payment first will come first in your Indian bank account. Then from Indian bank account, you can even remit back. So like this work. So you have to conduct regular internal audits. That there will also a huge opportunity for us as a chartered accountant that we can conduct regular internal audits for these and stay updated. And further, there's a FEMA rules, RBI notification will change periodically. We need to check that. So another thing is that, for example, if we have done any export, we have a receivable, but due to any bad debts or client situation, we are not able to receive that amount. We have to write out that amount. Is this allowed under FEMA? If allowed, how it can be done? So what are the compliances for this? So we have received many queries for this also. So we have write down that. So when can write-off focus export proceed remain unutilized before the stipulated period? So if the export proceed remain, for example, up to 12 months, it is allowed after 12 months. After 12 months only, you can proceed forward to write off, but reason should be sufficient. Reason should be there, like buyer insolvency, dispute or quality issue. For example, if you have exported some goods due to quality issue, they have hold the payments and they are not paying, or because they have any they raise any quality claims also, like political risk, natural calamities, anything may be reason, but it should be reasonable. Only that case you can write off. So how it can be write off? Who can approve the same? AD banker can approve write off up to the 5% of total export amount during the previous calendar year for self write off by the exporter. So that is 5% of total export proceeds realized during the previous calendar year. For example, if in previous calendar year, I have exported for 1 lakh USD and 1 lakh USD, 1 lakh USD is received in my bank account in the previous calendar year, up to the 5% that amount. So 1 lakh to 5% that is 5,000 USD. Up to 5,000 USD, if I want to settle down, if I want to claim as a bad debt, up to 5% only, up to 5,000 only, that only be allowed by AD banker. So in the case, 5,000 limit can be extended to 10,000, but that be subject to some conditions. Above 10,000, if I want to make write-off, then only RBI approval is required. So if I want to write off for example, 1 lakh USD, complete USD, then RBI approval is required. Even if I want to write off 11,000 USD, then also RBI approval is required. What are the conditions? There should be satisfactory documentary evidence for the reason for non-realizations, no pending litigations or investigation related to export transactions. Exporter are under non-question list by FBI. So basically, there should be proper documentary evidence. There should be proper follow-up. For example, first you have sent emails to the importer to whom you are asking the money that please clear our dues, like that. There shall be proper documentation, email chain. There shall be proper email, fax, courier of the documents. You will also have to initiate the kind of litigation, so that you have to file the case for the same. So if the amount is not so big, so it is not mandatory to file the case with the local court, but you may send legal notice to the client that you're liable to pay such a sense amount. Please clear the dues, like that. So there shall be clear communication, email chain, and you have make the it. We have to show to the RBI, AD banker, that we have made the sufficient evidence. We have to make the sufficient efforts to recover the amount, and as the amount is not recovering, that's why we have come to you for write off the amount. So we have to prove that. So onus is up to on the exporter for the write off. So you have to make the application with AD banker with justification of write off, copies of export invoice, shipping bill, correspondence with the buyer, evidence of realized payment, auto certificate confirming accounting treatment also. That is also need after the amount is approved by RBI. So what are the impact of write-off? Whatever the export incentive, duty drawback you have claimed and need to be paid back. Also, you have to update EDBMS record with write-off approval. So now is earlier we are discussing write-off against export receivable. So another is whether write-off of advance paid to import is allowed or not. Yeah, that is also not allowed. For example, that I have made an advance to any vendor of foreign country, but they have not shipped the goods. Then they might be he is fraud or something, or contract cancel or partially executed and they forfeited the amount, or because of supplier default or become insolvent. There might be the cases. There are some example. There are some example. There can be many more examples like that. There can be any reason, but it should be reasonable in the eyes of the law. It is also governed by the FEMA Act. Normally 6 months of the remittance date. Import advance must generally be adjusted against import within a stipulated timeline. Normally 6 months of remittance date, extendable up to 3 years. It can be extended up to 3 years after the approval of the AD bank. So, for example, there are some big projects are there. So, in that case, it will require specified manufacturing of any machinery. So, it may take 2 years, 3 years. So, in that case also, AD bank may grant the approval for importing the goods after basically stipulated timeline. So in that case, if advance remain unregistered beyond that period, then you can write off to the AD bank for the write off. So in that case also, you have to prove importer by documentary evidence of supply inability to deliver goods or service. Efforts for recovery has been failed. You have to show that. So in that case, RBI approval is required for exceptional case of large amount beyond RD bank authorities, like that. We have mentioned in next slide what are the threshold for the same. So what are the conditions of right of import is not under obligation by any regulatory agency, no trade dispute pending under litigation in India, and importer submitted and taking that benefit of right of is not misused. For example, sometimes it occurs that I have paid advance to any company in foreign country. In India, I am asking for right of, but Indian person, they have taken the amount in some other account or purchased the property from that account outside India. So that should not be there. So just 1 second. I think window is closed. I'm again sharing.
Raviji, we have various queries also from members. After your deliberation, we have
Sure,
to take those queries. Please
sure,
continue.
sir.
Please
yes, I'm sharing this again.
Yeah, continue. Please continue.
Yes. So whether write-off is allowed or not, yes, it is allowed, but subject to some conditions. So What are the documentation requirement? Application of AD bank with reasonable write-off. Just 1 second. So application to AD banker with reasonable with reason for write-off, copies of invoices, contracts, swift payment details. You have to we have to show that correspondent with supplier are providing effort or recovery. This is the major thing that we have to prove that we have made the sufficient efforts for recovery. CA certificate confirming account for entry of write-off. We have to show these documents to the AD banker. So importer must book the write-off as a loss in the books of account. You have to report in IDBMS. So AD bank can approve the write-off up to 1 lakh USD per transaction. Where the goods or supplies are not supplied, supplier become insolvent, document evidence of no recovery is furnished, importer is under investigation, not under investigation, complied with KYC norm. So if write-off exceed 1 lakh USD, या फिर case involved where importer is under investigation and complexity where AD bank is not satisfied, or where multiple write-off that raise compliance concern, in that case also we require approval for RBI. So this is all about the FEMA. Now we can come under USA taxation. So I will give you a brief overview of the US and UAE taxation as it's already 5:26. So we have to be fast in that case. So what US taxation says. What are the type of entities allowed in US? What are the taxation in US? So in US, the taxation is kind of multi-layer. So for example, in India, Indian government, central government is levying tax at central level. For example, if we are in Delhi, so Delhi government will have separate state income tax. Haryana government has separate income tax. So like that, it works in US also. And also, there's also local tax. For example, at Haryana, if I'm at Gurgaon, so Gurgaon have a separate local income tax. So there's a 3-level tax in US, that is federal tax, that is administered by the IRS, so Internal Revenue System. So basically, this is federally, this is a basically kind of income tax in India. Similarly, IRS in US. Second is state tax. For example, there are the 50 states in the US. Every state has different income tax. For example, Florida has separate income. Florida has zero income tax. Texas state is there. There's a zero income tax there. For example, at Wyoming, there's a zero income tax. For example, if you go at Washington, there's a 6% tax. In New York, there's a tax on turnover basis. In Delaware, there's a 0% tax in case if the goods are not entering into Delaware. So there's a 50 states, and in each state, there's a different tax state. Another is local tax. So in which city you are doing the business, on that city basis, there is a tax. So there might be 1%, 2%. So there is generally 0 to 1% tax in local tax. So another is federal tax, that is 21% imposed by the federal level. State tax vary from 0 to 7%. There are 5 to 6 states in the US where they are levying 0% tax. Other states are levying from 0 to 7%, like 1%. Some states levy 7% tax like this. Another is local tax, that is vary from the state, city to city where you are working in US. Another is sale tax. So like in India, that is there is a CGST and SGST. So that is SGST is specifically levied by SGST can be changed by any state. For example, Delhi GST has separate, can change, they can have separate laws. Haryana GST can be separate laws. Similarly, in US, states have their local sale tax laws, and also there is no any federal sale tax. So federally, they are not levying any kind of sale tax, but states have separate state tax laws. And also in US, there is a destination-based tax. For example, if I am a company, I have operating from Delaware state. So if I am selling my goods or selling my services to some other state, for example, in Texas, so Delaware state laws, state sale tax laws, not applied in my case. I have to comply with the Texas state laws. So in that case, we have to say in which state you are in providing the services. On the basis of destination states, we have to check the state sale tax. So like that in this working. So in US, there's a 50 sale tax laws, 50 local tax laws, and 1 federal tax laws. So like this, they are the 101 laws. Other than this, there are many other laws that are applicable in these cases. So in Big Four, they are the separate team. They are the separate team for the each state. There's a separate team for the each state tax. There's a separate team for the each state income tax. There's a separate team for the each local tax. So there's a major things that need to be checked. So what are the type of entities that is allowed in US? So basically in US, there are basically two type of entities, that is corporation or LLC. So they are further part I will let you know. So there are the two type of entities in US, that is corporation or LLC. Corporation is just like private limited company in India. But the corporation further have two parts, that is C corporation and S corporation. So C corporation is exactly same like a private or public limited company in India. If you think as a private limited company, you can check it is a separate legal entity. Similarly in India, it is taxed as independently. Similarly, in the case of Indian private limited company, so there is a double taxation in this case. That is, corporation pays 21% federal tax on profit. Shareholder pays tax again on the dividend. So that's why I'm saying it's similarly as per the private limited company in India. You must think of Indian PLC and can check as C corporation. That is, both are the same. So another is S corporation. This is kind of similarly like LLP in India. So in S corporations, only US resident can be a part of S corporations. If there's a any foreign person. Now I'm talking from the US perspective. So foreign person means any person other than US who have citizenship of other than US. Any company that is incorporated outside the US. So now I'm telling from the US perspective, thinking that we are the resident of US, we are speaking of US perspective only. So as an S corporations, so only the US resident citizen can be the shareholder. Any foreign person that is not the citizen or resident or corporate of US can't be the person of S corporation. So this is kind of LLP in India. So in that case, what are the profit that is earned by S corporation? So there's also some difference in LLP and S corporation. So in that case, for example, it has earned profit of 1 lakh USD in US. So 1 lakh USD is not taxable at entity level in US. So 1 lakh USD will be further basically distributed into partners at their profit sharing ratio. Now that partner, when they're individually filing their individual tax return, in that tax return, they will pay tax on that income. For example, there are two partners, 50-50% partner, S corporation. S corporation is earning 1 lakh USD. So we have to file S corporation return by showing that we have earned 1 lakh USD as a profit, and they are the two partners in this entity whose SSN or IT need to be mentioned, and they have earned 50,000 each, 50,000 each. That need to be mentioned. So first return need to be filed with the S corporation. So now when we are filing the individual tax return, in that return, we will tax that 50,000 USD as a business profit and pay the tax on that at the slab rate. Basically, kind of Indian entity, for example, REIT, you might heard REIT, InvIT, REIT, like that, it will be taxable in India. Another is LLC. So that is corporation. Now, second is LLC. So what is S corporation? Similarly, for like S corporation, we can opt partnership in the case of LLC. So in LLC, three type of structure that is allowed. You can opt three type of tax structure. You can opt any one out of three. The first is partnership structure. For example, if that LLC have two or more partners, they can opt for partnership. In this case, for any foreign person or foreign company, they are allowed to opt this structure. So this is similar kind of S corporation. Only the difference is there are some other difference, but the main thing is that in this foreign partners is allowed to the partner in this case. So in this case, we have to file the return of LLC, and the income is not taxable in the hand of LLC. The income is taxable in the hand of their partners. They are now partners, and we have to file separate return for the individual partners. So this is the kind of partnership. Another is sole proprietor. So if that LLC is a single member, So in US, in US, even a single member can open the company of INC or LLC. So if there is only one partner, they can opt as sole proprietorship. So in that case, the LLC will be disregarded, and the any income or sale of LLC will be reported in the hand of individual in their personal income tax. So kind of you heard that is corporate lifting, corporate wheel basically. So this is kind of corporate wheel. So we will lift the structure, we will lift the wheel over the LLC, and that income is taxable in the hand of sole proprietorship. So the third structure is kind of C corporation only. So in LLC also we can opt the structure of C corporation. So if two-person form a LLC, they can either go to a partnership or either tax the LLC as a C corporation, that is a private limited company in India. So you can opt any tax structure. You have to opt the tax structure after the incorporating the company, or you can also opt after that, but there's specific conditions for that. So what are the federal income tax for individual? It is progressive from 10 to 37%. If you might have many clients who are basically they was Indian. Now they have shifted to US. Now they are the green card holder of the US. So in the case of if you have clients and green card holder, in that case, their global income will be taxable in the US also. Their global income will be taxable in the US. So you have to tax that income completely. You might have clients, for example, who are earlier US citizen, now doing business in India. So that client also, that whatever the income you are earning from business income, whatever the income he have in India, that is taxable in US. That Indian person have to file, that Indian resident that was earlier US citizen then need to file his US tax return and have to declare everything in US tax return, and that income is taxable in US. But you might get the exemption for that. That's a separate topic. But yeah, that income is taxable in US only. So for corporation, it is taxed at 21%. That is applied to taxable income. Pass-through entities, no federal tax at entity level. Profit loss pass through the entities person level. Owners pay individual taxes. That is at slab rate. Another is additional federal taxes. That is AMT. That is applied in individual cases. Some individual cases also applies on corporate that have turnover turnover exceeds specified limit that have to pay AMT. Another is NEAT, that is net investment income. So in case if the turnover is exceeding specified limit, so in that case you have to pay the net investment income tax on that income. So investment income is kind of passive income that have any dividend income, capital gain income will be covered in this. So capital gain tax, short-term tax is ordinary income, long-term will be at preferential rate, and time period is similarly as in India, 12 months. If it is 12 months or less, it will be short-term. It is more than 12 months, and it is long-term. Another is state corporate income tax, that rates vary by state to state. That is 0 to 12%. There is no corporate income tax. Some states have no corporate tax, like Wyoming. High corporate income, like New Jersey, there's around 6 to 7%. Pennsylvania is around 6 to 7%. So whenever you advise any client to open the company at US, so we have to check that what state is best for that. For example, if they have not to do any business in New Jersey, then it's better not to open the company at New Jersey. It's better to open the company in Wyoming. But if they have clients in New Jersey, so it is better to open a company in New Jersey only. Otherwise, there's applicability of foreign business license in that case. So another is franchisee tax return. So in US, there's a concept of franchisee. Similar like MACD charge franchisee fees from their vendors. Similarly, in US, if I open a company at Texas, what Texas state government says to me, they are saying that you are using my name to pitch your clients. So they are talking like this, that you are using my name to pitch the clients, to pitch a prospective client. So I will charge the franchisee fees of business privilege taxes from you. So likely every state have different franchisee tax. Every state has different rules for franchisee tax. So someone charge on demand basis on revenue, some are charging on a net worth basis, some are charging on flat fees basis. That so this need to be filed. Another is sale and use tax. So there are two types of tax, that is sale tax and use tax. if I purchase the goods from some other state and consuming in my state, in consuming in specific state, so that state may ask for the use tax. So similarly, property tax is there, local income tax is there. So there's a specific tax. Another is payroll tax. So, like in India, there are EPF, ESI. Similarly, in US, there is Social Security tax that is 6.2%, 6.2, that is 12.4%. Medicaid tax that is 1.45 need to by employer and employee. No, so that need a Medicaid tax need to be paid if the employee is hired in the US. Another is federal unemployment tax that need to pay on 6% on first 7,000 only. Another state unemployment tax that vary from the state to state. Other is you have to withhold the federal income tax from the employees. You have to take various forms while if the employees join in your organization. You have to file quarterly 941, 940 for payroll taxes. Like India, we are filing monthly EPF return, ESI return. Similarly, in the US, there are payroll taxes. Annual wage report, we have to issue the form W2 for the employees. Similarly, we are issuing form 16 to employees in India. Similarly, there is W2 for employees in there. So there is a residential rule. Any US citizen are considered resident of India. If they're the green card holder, this will be considered resident of India. Their worldwide income will be taxable in the US. So the US citizen will be taxable in the US. Another is substantial presence test. So if you are living in US for 31 days in current year means calendar year there, and 180 days over the last 3 years, then we have to calculate through Beatty's formula method. If they satisfy these conditions, if they will be considered as resident of US. Another no resident alien, they will be taxed only on US source income. They must file 1049 NR, that is their US tax return. So whatever payments any US citizens, any US company making to any foreign citizen, they have to deduct TDS, the kind of thing. TDS, you may say, on dividend it is 30%, does 30%, royalty 30%, but it may change, reduce after the tax treaties. For example, as for India USDT, it is 20% on royalty, so they have to deduct 20% on US. Another is DT, double taxation relief. Similarly, in India, there is a relief in US also for foreign tax credit as per the DT available between US and that their host other countries. There is another requirement of FAT-CA, that is US person if hold any asset outside the US. For example, if any US citizen doing business in India and they are holding specified asset, they have to file FAT-CA. Similarly, they have to file FBR, FBAR. If they are not filed any of these, there are thousands, there are penalties in thousands of rupees. For 25,000 for FAT-CA, FBAR, they will be around 10,000 USD per year. This compliance need to be done on yearly basis. Another is transfer pricing. For example, if Indian company open the company at US, both need to be compliant for the benchmarking. If Indian company not do the benchmark as per Indian laws or US company not do the benchmarking as per US laws, both are under scrutiny phases. Then they will face a huge penalties for that. So whatever the transactions occurred between a related party, so they are the limitations, they are the threshold in every country for the transfer pricing report. But nowhere has said, no country has put the threshold for the benchmarking set. So you have to do the benchmarking even if your turnover is below the threshold limit for that local transfer price report requirement. So we have to comply with this. So you have to take EIN, federal income tax filing form 1120, need to file 1065 for the partnership. So due date is 15th of April, but it can be extended by 6 months by easily filing a simple form. There are the payroll compliances, there are state and local tax compliances, there are informational return that need to be filed. So last, whether I have to continue for UAE or how to do? I think it's around 5:41.
How much is
So
remaining?
10 to 15 minutes, I can conclude UAE. I actually make this in concise way.
If members are interested, we can continue. We don't have any problem because this is for the members. If
Yeah,
I
please,
think
confirm.
more than 40 members have already joined. So members, please give your suggestion whether he should continue for 10-15 minutes and after that we will take the query, or should we conclude here and take the query one by one. Please give your feedback. Please continue, sir. This is the request from the member. Please continue for 10, 15, 20 minutes. And after that, we will
Yes.
take the query. Please continue.
Sure, sure. So UAE is a hot, basically a kind of hot country now, where everyone is moving to UAE as of now. So why everyone is going to UAE? Because there's a corporate tax of only 9% at UAE. So some are thinking that if you open a company at free zone at UAE, we can easily avail the exemption of zero tax benefit at UAE. But it is not the fact that everyone is thinking. So in case, so I just want to give a brief highlight earlier. So for the current tax regime, corporate tax implemented after 1st June 2023, VAT is introduced on 1st Jan 2018 at 5%, excise tax only on harmful product. There is no any personal income tax, so only corporate tax is there, but only if individual is doing any business. So if that business exceeding specified limit only, then have to pay the tax on that income. So free zone, what free zone is saying, someone, if you have opened the company at free zone, it doesn't mean that you can avail the zero tax benefit. There's a specified limitation. There are the many restrictions to claiming the zero tax benefit in free zone. For example, you have to prove that we have a substance in that free zone. Only then you can claim the exemption. For example, if you have not opened the office in free zone, you have not any substance at free zone, then you cannot claim the exemption. So in that case, FTA may levy a huge penalty on also the corporate tax on that income. All federal tax managed by the FTA, like CBDT in India, there is FTA, federal tax authorities there. So what is covered, who is covered under the UAE capital tax laws from 1st June 2023? Mainland companies, that is company formed other than free zone are covered. Free zone companies with specified for qualifying income. Another is foreign entity that are registered in UAE as a PE, that have PE in UAE, they can register as foreign entities that are also covered in it. What are taxable income based on the accounting profit? Basically, IFRS is applicable at UAE also. That is adjusted by any tax rule. For example, some tax that any expense that is not disallowed by the tax rule of the UAE, that is not allowed. So that will be adjusted in the taxable profit in there. What are there are some exemption for the government bodies, extractive industries, that mining industries, qualifying investment fund, public benefit entities that are not covered. So you have to file compliance. What are the compliance? You must register with the FTA for the corporate tax registration. You have to file annual corporate tax return, have to pay tax. You have to file the tax return after within the 9 months of the end of the year, financial year. So financial year is the choice of the company. Who's the company? There can be a calendar year, there can be any financial year, there can be any year of 12 months specified by the UAE newly formed company. So what are the corporate tax rate? It is 0% up to 3.75 lakh AD. It is 9% for above 3.75 lakh. So if I have earned 4 lakh AD, so up to 3.75 lakh, it is zero. For 25,000 over and above 3.75 lakh term, it is 9%. For 15% for some large MNCs. So for if I free zone person and have earned qualifying income, so in that case, the tax rate is 0%. So this is the major benefit that company can claim, but we have to make sure there's really substantial presence of that company. There will be employees in the free zone doing working there. They will be benchmarking. They will be benchmarking there like that. So another is 9% on mainland or non-qualifying income. That is taxable in that case. So VAT in UAE is introduced from 1st Jan 2018. That is 5% of most of goods and service. So if your turnover is exceeding 3.75 like the AD, you have to register for VAT. If you want to take voluntary registration in VAT, then in that case, your turnover must exceed 1.75 lakh AD. If turnover exceed that limit only, then only you can take voluntary VAT registration. Otherwise, you're not eligible to take voluntary VAT registration also. So there's a zero rated sector. If you're going doing export of goods and services, international transportation, certain healthcare, education service, in that case, it is a 0% tax rate. what are the compliance need to do? You have to register with FTA, VAT return must be filed quarterly, invoice must meet VAT reporting requirement like GST in India. So there's excise tax also in UAE that is introduced 2017 for disguised consumption of harmful goods and generating revenue. So like tobacco goods, tobacco product, it is 100% excise duty. Energy drink, it is carbonated drinks, electronic smoking device, there's 100%. So like this, there's excise tax in UAE also. So similarly, you have to register with the FTA. So everything need to be do through FTA only. There's a separate bodies in India like GST, income tax, like CBDT, CBIC, but in UAE only FTA we have to deal with. So there's a no personal income tax, even employment income generated in UAE is also tax free. Individual contracting business under licensed commercial activity may be subject to commercial tax. That is, I was earlier saying that if your turnover is exceeding specified limit, then business tax may be levied. No inheritance or estate tax in UAE. There is an inheritance estate tax in US, but there is not any such tax in UAE. So they are the most, UAE has signed more than 140 DTAA with countries worldwide to avoid double taxations, reducing withholding tax on dividend, interest, and royalties. So they have limited the taxation right of UAE with 30 partner countries. You can avail tax credit, FTC in UAE, and also claim exemptions. That is, for example, if Indian company earned any income from UAE, if as per DTA between India and UAE, that is taxable in India. So that is taxable in India. You can claim exemption benefit. So like that, majorly DTAA is complied with the OECD guidelines. So there will be not any issue of double taxations. So UAE is now becoming major hubs actually. So there are the two types of company. We can form the companies two type. You can form the company at free zone or mainland. So free zone is like SEZ in India. So in free zone, there's a very less restrictions, compliance are very less. So you can easily open the company at free zone, and also if you're doing export from free zone, in that case, there's a 0% tax rate. So there's a major benefit there. Many of the companies are open in UAE just for the purpose of raising the invoice and receiving the payment. So in that case, there might be the issue of the POEM in India. For example, if Indian company open the company at UAE, free zone company, they are doing high C sale from UAE company, and no one is sitting in UAE, and that company, Indian company, is doing business from India only. So there are the huge chances that POEM may trigger in India. That is place of effective management. You might heard a notification that is issued by the income tax department for POEM, place of effective management, where they have defined the ways that how it can be find out, how place of effective management can be find out. In that case, it will be triggered, and UAE company will be considered as a part of Indian company only. So that whole income will be considered taxable in India. So this is a major thing that need to be complied with. So I have given a brief overview for the FEMA, US taxation and UAE taxations. Yes, sir. So we have concluded US,
Thank
UAE,
you.
and FEMA.
Thank you, Raviji. Should we take now the queries of our
Yes, sir.
members?
Yeah.
Since starting, I am taking. So first query from Preeti Kevlani. When is 400% net worth is checked?
So that we have, sir, already resolved
Okay.
out, for example, 400%
Okay.
as per the last audited financial statement.
Okay.
So if we are done the investment of 1st of April 2025, we have to check the 31st March 2024.
The second request from the member Kuldeep Pandey is, we will get this PPT. Is this possible? If possible, then you provide me, I will share with the members.
Sure, sir.
No issue. Now the next query from Varun Kumar. Can certificate of valuation of share be given by a practicing CA for ODI?
So for ODI, if for ODI perspective, if it is an initial investment, if you are open the company as a subscriber memorandum, then no valuation certificate is required. If it is a further investment, we are purchasing a share, then Indian CA can give if it is within the prescribed limit of the 5 million USD. So if it is as per NAV method, so we can give, that's not an issue.
The next query from Vinita Bindal. During I heard resident cannot give gift to non-resident. Is it true?
So if they are the relative only, then they can give. Otherwise, it is not possible. We have to comply with the FEMA guidelines, take RBI approval necessary.
Harsh Mittal query. I am licensed US CPA. I have authority to audit the financial statement for US.
Sorry.
There is a query from CA CPA
Yeah, sir.
Harsh Mittal.
Mhm.
I am licensed US CPA.
Yeah.
I have authority to audit the financial statement for US.
Yeah, sir.
He's asking whether he can audit the financials of US statement.
Yeah, sir.
Okay.
He can, not an issue.
Yeah. So next query from Barun Kumar. Valuation of shares as on 31st December 24 will be accepted for ODI application being made today.
So we need to check that on what date they have purchased the share. So basically, older than 90 days is not allowed in any case. But we have to check when, for example, on 31st December, they have done the valuation and transfer the share on 1st of April or 31st of March, basically, then it can be allowed.
Next query from Harsh Mittal. Can you now add Canada also to your services? I can provide company incorporation, tax filing services and assurance services for Canada as well as. So Harsh Mittal ji, you can contact directly to Ravi Kumar ji. So his number is given there. You can please contact him personally. So PPT BIRC is also acceptable, sir.
In which case, sir, they are asking?
Okay. Harsh Mittal ji, you can ask your query directly to the Ravi ji after this session. His number is there. So next, contact detail of any reaching with respect to consultancy. Sir, Shikhar ji, the number has already been given by Ravi ji in his PPT. You can contact him directly if you need any services. Shubham Sehgal ji, one of our client received amount from importers but issued less bill for the same. How to deal with this situation?
So if the advance amount is still outstanding, or if they are not repeating event, then you have to approach the AD banker for write off that amount and to show the reasonable that you have made the reasonable effort to recover that amount with the reasons that why they are not paying. So you have to approach the AD banker for that for write off.
Now, Ankit Khandelwal ji is asking, if funds not received after 24 months in the case of export, then what are the compliances one need to do?
So in the case, if the fund is even not received after 12 months only, so in that case, you have to approach the AD banker for the write-off. So you have to apply the AD banker and make a sufficient evidence that you have made a sufficient approach to recover the amount and have not received that amount. So you have to approach the AD bank for write-off the same.
Okay. An individual has purchased flat in Dubai last year. What FEMA compliance does he need to comply this year? Is there any form as part of compliance? The entire amount was within LRS limit for reference.
So if they have repatriated the same through AD banker, so after that they are not to file any specific compliance. They are just to have to report in ITR form for an asset and liability schedule.
Any individual? Okay, this is done. One of our client received amount from importers but issued. This query has already been sir. What are options for sole proprietor to open branch in US or Australia, sir?
So in US, a sole proprietor can open the company as a single member LLC or single member INC. There is not an issue in that case.
Okay. And how complex is repatriation of fund will be done between two units?
So from where to where? Repatriation funds from which country to which country they are asking?
US is his
So
earlier question was US or Australia.
okay. So there's not any complex situations. You can easily repatriate the amount from the US to India by the way of dividend, salary. So there's not any issue in that case.
Shubham Saigal ji is saying, can I call sir on
Sure,
the
sir.
provide number? Please, Shubham ji, please call after 10-20 minutes after this session. You can talk to him directly. Now, Deepak Rao ji is asking, are the free zone companies registered in UAE mandatorily liable to audit? What are the audit requirement in UAE?
So in this case, if the company is registered in free zone and they are availing 0% corporate tax rate benefit, so in that case, they have to do a mandatory audit. In case that company is not availing 0% corporate tax rate benefit, so in that case, the limit is 50 million AD.
Now, next query, if resident person in India wants to give to non-resident son, can she transfer the amount in NRO of son account? Does LRL limit applicable?
So if the amount is transferred to NRO account of Indian from his son to his son basically, so in that case, LRS will not apply in this case.
Okay. Can a resident individual invest in an overseas SPV?
So that need to be checked, but basically, what is the purpose of that SPV? Whether they are for investing in financial sector, then it is not allowed. If they have individual, in any case, will not allowed to invest in SPV if they open the wholly owned subsidiary. So step-down subsidiary is not allowed in that case.
So Kishore ji, you can talk to him directly and ask your specific query. Can such investment be made without incorporating the end entity non-finance sector?
So in the case of individual, step-down subsidiary is not allowed in any case. But if individual is investing in any SPV that holds less than 10% and also does not have control in that entity, then only that individual can invest in SPV.
So this is all about the queries, sir. So thank you very much. First of all, I am thankful to Govindji for giving a wonderful deliberation, and then CA Ravi Singla ji and our session chairman CMA DC Arya ji, and most important thanks to all the members attending this our webinar very interactively, although the time was up to 5:30, but it is 6:05 now, so I am very happy that our members are taking so much interest in learning. So with this, I am thankful to all of you. Thank you very much. Thank you, Ravi ji.
everyone for your
Thank you,
patient
thank
listening.
you,
Thank you, Raj
everyone.
sir.
Bye.
Thank you,
Thank you, sir.
Thank you, Ji.
Thank you.
Thank you, everyone.
thank you, everyone. Thank you.